Right now, an absolute panic is gripping the entire property world. Every potential investor, from the eager first-timer with a small down payment saved up to the seasoned veteran thinking about their second portfolio addition, is paralyzed by the same, singular terrifying choice. It is the choice that keeps you up at 3 a.m. Do you dare to buy now and risk losing a devastating portion of your life savings if the market collapses? Or do you listen to the economic prophets, wait for their inevitable crash, and risk missing the single best investment opportunity you will ever see? The fear is palpable. You are constantly bombarded by headlines: the Federal Reserve hiking rates again, local landlords aggressively selling up their portfolios, and every major news outlet predicting a dramatic, painful housing market collapse. This atmosphere doesn't just make you hesitate, it fosters a paralyzing, gut-wrenching dread. And that dread is completely justified. Think back to those who acted at the wrong time. If you had bought the average property in a major metropolitan area just before the last true downturn, you wouldn't just have faced an awkward moment, you'd have been down by £50,000, maybe more, within 2 years. That's not a mild financial setback, that is a personal disaster, a loss of freedom, and a source of deep, lasting regret. No one wants to live with that outcome. But here is the critical, often missed paradox. What if that fear, that constant, agonizing hesitation, is the very thing that is guaranteed to cost you far more money than any crash ever could? What if the real, permanent danger isn't making a bad move, but simply failing to move at all? We have worked alongside investors for well over a decade, and what we consistently observe is that the relentless, obsessive search for the perfect time to buy is not a strategy, it is a sophisticated trap. A psychological cage that has cost smart, cautious people hundreds of thousands in missed rental income and irreversible capital growth. It is time to stop letting fear dictate your future. We are going to expose the most common lie investors tell themselves about timing, and reveal why the secret cycle that accurately predicted the last 2 crashes might be dangerously, fundamentally wrong this time around, leaving those who wait standing on the sidelines forever. Before we dive into the controversial data and the deep emotional cost of waiting, if you want the unfiltered, inside track on the property market and the raw, actionable strategies we use to consistently build wealth, you need to hit that subscribe button right now. Don't wait. Don't let paralysis win. Let's get into the devastating truth. The fundamental issue is that every potential investor suffers from an intense form of financial perfectionism. They are obsessed with finding the absolute lowest point in the market, the theoretical, perfect moment, where prices have bottomed out and rates are about to plummet. So, they wait. They wait for interest rates to drop from the higher levels we've seen, they wait for nominal house prices to crash hard, they wait for the media to report peace and stability. They are waiting for a signal that is clear, loud, and completely risk-free. This obsession with precision, however, is not smart, it's a crippling psychological ailment. You are glued to the financial news, looking for some cosmic sign, actively choosing to be paralyzed by the fear of dropping a significant investment just before a downturn. But you must absorb this brutal, undeniable truth: waiting is an active, definitive financial decision, and it is just as expensive as acting too early. Let's run the numbers on real, devastating regret. Consider the individual who, in 2012, looked at the post-crash wreckage and thought, "It's too soon. Prices might fall further. I'll wait for certainty." That smart, cautious, risk-averse individual has now missed out on well over £100,000 in capital appreciation, money they will never recover, plus an entire decade of steady, consistent rental income. That is not a temporary dip in value, that is a massive, permanent, irreversible loss of generational wealth. This is the cost of waiting, and it's almost always more brutal than the cost of a temporary correction. Think about the more recent history. Even those who paused for just a year during the initial COVID uncertainty have missed roughly £50,000 or more of accelerated growth and the most aggressive, tenant-favorable rental market in recent memory. You must redefine your perspective. The fear of loss focuses on a short-term drop in paper value, which the market often recovers from. The reality of waiting is a permanent loss of compounding growth and steady cash flow. The money you forfeit by sitting on the sidelines for too long is often greater, and critically, it is far more certain than the money you might lose in a brief market wobble. The market is not the problem, the paralysis of choice is the true enemy. You can get it wrong by buying too early, yes, but the historical data overwhelmingly shows that you are far more likely to get it devastatingly wrong by simply sitting still and waiting for a perfect moment that only exists in history books, not in real time. The source of this overwhelming, paralyzing dread and the justification for many people's wait-and-see approach lies in a notorious economic theory that has taken on an almost doomsday, cult-like following, the 18-year property cycle. It is a compelling, terrifying narrative because it is based on serious data, hundreds of years of housing market history, developed by the respected economist Fred Harrison. And here is why it commands such fear. Harrison is credited with correctly predicting both the painful 1990 market collapse and the catastrophic 2008 global financial crisis. Think about the sheer power of that track record. Two major, generation-defining global catastrophes, seemingly predicted by one simple, cyclical framework. The core of the theory suggests that the property market moves with an almost fatalistic, predictable rhythm, a sustained 14-year period of growth, a small, mid-cycle dip, like the one we saw around 2006, 2007, followed by a giant, euphoric, manic boom towards the end, which inevitably collapses into roughly 4 years of brutal decline. By simply counting forward from the wreckage of the last true crash, the cycle's timeline screams a clear warning: we are currently nearing the peak of the next major cycle. With the current economic backdrop, this theory marks 2026 as the moment of reckoning, the predicted market peak followed by a guaranteed, painful downturn. It is the perfect story, simple, historically accurate, and a complete justification for every ounce of fear you feel about buying now. It whispers, do nothing. The profits are coming, but the pain is first. Wait for the carnage. But before you panic, sell any existing holdings, and commit to standing on the sidelines for the next 3 to 5 years. You must take a cold, hard look at what is actually happening in the market right now. Because that historically accurate data, that terrifying, beautiful framework, is currently telling a very different, and very dangerous, lie about our immediate reality. The market conditions that the 18-year cycle requires for its predictive power to hold true simply do not exist in the current moment. We are not experiencing the runaway euphoria, the reckless credit, or the irrational exuberance that typically characterizes the final boom phase. If you rely on this theory alone, you are relying on a prophet whose timing may have been completely disrupted, and whose warning of a coming event is based on a starting gun that may have already fired. It's a compelling, terrifying model, but models are meant to be tested against reality, and the current reality is telling a much more nuanced, and urgent, story. If we were genuinely trapped in the late stage of a manic, pre-crash boom, as the 18-year cycle vehemently predicts, the economic environment would be pure hysteria. We would be witnessing the kind of signs we saw in the mid-2000s or the heated rush of 2021, runaway, parabolic prices, lenders giving money away recklessly, and buyers abandoning all financial caution, throwing cash at whatever they could get just to feel like they were in the game. That is the hallmark of a bubble ready to burst. But look around you. That is not what is happening in the current market. In fact, we are seeing the complete opposite. A large, significant shift has occurred, but it has happened so quietly and without the drama that the media loves, that many investors have completely missed it. This is the silent correction. Since the major interest rate hikes began in mid-2022, prices haven't collapsed in a headline-grabbing way, but they have already fallen by a staggering 15 to 20% in real terms once you account for the severe inflation that has ravaged the global economy. Nominal prices might look flat, which is why people are still panicking, but once you factor in the undeniable erosion of purchasing power, the market has already absorbed a massive, meaningful, and painful correction. This silent, non-dramatic price adjustment has actually accomplished the same purpose that a violent crash normally would. The market has decisively cooled, the irrational buyers have been shaken out, listings have increased, properties are taking longer to sell, and critically, smart buyers suddenly have leverage again. All of this is the antithesis of a manic, pre-crash environment. This is why relying purely on the 18-year cycle as your definitive timing signal right now is a dangerous flaw in your investment planning. The founder of the cycle, Fred Harrison himself, has acknowledged that massive, disruptive events, like the recent COVID pandemic, geopolitical conflict, or the sudden, aggressive interest rate shocks we've just experienced, can completely throw off the predicted timing. We are not staring at a bubble that is about to burst. We are standing in a market that has already quietly corrected itself and is now searching for stability. The fear of the crash is based on outdated signals. You need to adjust your strategy. Waiting for the big one might sound like a sensible, patient approach, but it could very easily mean waiting many more frustrating, expensive years, completely missing out on the solid buying conditions that are quietly materializing right now. If the current stability is not the manic peak, then the crucial question shifts: what exactly is the real danger zone that you absolutely must avoid? You are waiting for things to feel calm, certain, and predictable again. You are looking for a clear sign, like a blue sky before a sunny day. But you must internalize this investment truth: if you wait for everything to feel calm, safe, and easily predictable, that is not the signal to buy, that is the undeniable signal that you have already missed the window. Let's look at historical investor psychology. Go back to 2006 or the extreme boom of 2021. During those periods, everyone, your friends, your neighbors, the cashier at the grocery store, was enthusiastic about property. There were no clouds on the horizon, the news was ecstatic, and confidence was running at an all-time high. These euphoric, comfortable conditions, the exact environment you might be waiting for, were, in fact, the absolute worst times to buy. These were the final, manic pre-crash peaks where the potential for getting severely burned by a subsequent correction was at its maximum. The real danger zone isn't the quiet correction where you have leverage, it is the euphoric, herd mentality peak when everyone feels like a genius and risk is totally disregarded. The money is made by acting when others hesitate, not by joining the celebratory crowd at the top. So, if buying during a predictable boom when everyone is enthusiastic is the most dangerous move, does that mean you should adopt the opposite strategy and wait for the true crash? Theoretically, yes. Waiting for the market to bottom out and then buying the ensuing fire sale is the ultimate investor dream. But there is a massive psychological barrier that most people never overcome. You can't solve this problem with a spreadsheet alone. Looking back through history, we can clearly identify those brief, perfect windows when it was an objectively great time to buy, like the bottom of the market in 2012 after the last cycle's shock. But here is the critical point: what did 2012 actually feel like? It felt terrifying. Confidence was abysmal, the news was relentlessly negative, banks were hoarding capital and reluctant to lend, and if you told your friends and family you were about to put a large sum into property, they would have genuinely thought you had lost your mind. The truth is simple, and devastatingly hard to execute: the perfect time to buy feels subjectively like the worst time to buy. We only recognize 2012 as a good time now because we have the supreme luxury of hindsight. That is the ultimate cheat code. But operating in the present moment is a completely different game. Even if you believe you have successfully identified one of these rare, brief windows of perfect opportunity ahead of time, a much deeper question looms: will you actually have the nerve to act? Will you possess the financial liquidity, the steely nerve, and the psychological fortitude to be the only person walking through the estate agent's door when every single headline is screaming panic and everyone around you is liquidating their assets? This is the ultimate test. It's not a test of your math skills, it's a test of your character. The theoretical ideal is to buy low. The practical reality is that to buy low, you must be a contrarian, acting against the powerful, tide-like force of human emotion and fear. Going back over the past cycles, studying charts, and using clever economic models is intellectually interesting in retrospect, but no amount of smart analysis is going to grant you the cold courage needed to buy when the world feels like it's ending. The reality is that for most people, the paralysis of fear is a greater obstacle than the lack of capital. You spend years waiting, thinking you'll feel ready when the crash comes, but when that chaotic moment finally arrives, the noise, the fear, and the uncertainty are amplified so high that you freeze up and miss it anyway. You are too scared to buy the theoretical low, and then you are too scared to buy the subsequent recovery, and the cycle of waiting begins again. This brings us back to the crucial decision facing you today. What do you lose by simply waiting for the next 12 months? Scenario 1, the market eventually finds its footing and starts a slow, steady recovery, or even just bounces back to its pre-correction level. prices rise, and you have permanently missed the easy wins and the best available deals. Scenario 2, the market stays flat, exactly where it is today. You are still precisely where you started, but you have sacrificed a full year of potential rental income and have made zero progress toward your wealth-building goals. In both scenarios, the decision to wait results in an active, measurable financial loss. Waiting does not protect you. It merely delays your progress and guarantees a forfeiture of time and money. The key to long-term success isn't achieving superhuman timing, it's recognizing that the market is fine most of the time and acting with disciplined consistency. The 18-year cycle is a fascinating framework, but we must use it as a guidepost, not a rulebook. Its most enduring lesson is not about timing a specific date like 2026, it's about illustrating that there are only very short, dangerous windows when it is genuinely a bad time to buy. That window is the manic, euphoric 12 to 18 months right before a crash, the peak when everyone is acting on emotion and disregarding risk. The rest of the time, the vast majority of the time, the market is stable, or at least stable enough to allow for profitable, long-term investment. The investors we have personally seen build the most robust, sustainable wealth are not the smartest people in the room, nor are they the bravest gamblers who successfully called the bottom. They are, quite simply, the most consistent individuals. They possess the psychological discipline to avoid the extremes. They actively tune out the constant media noise and the fear-mongering headlines. They do not wait for the perfect signal, they simply act when a specific, individual deal makes compelling financial sense, adhering to their own predetermined investment criteria. That is the secret. It's not about timing, it's about consistency. Waiting for the perfect, fear-free moment is a self-imposed prison. It ensures you miss the compounding power of time, rental income, and steady capital growth. Your decision now is not about dodging a bullet, it's about taking disciplined action. You have already seen the silent correction. You know the true cost of waiting. The time for analysis is over. The time for action is now. Don't let fear cost you another year of progress.